which means we'll probably go live in about 20 seconds. All right, we are live.
All right. Hello, everyone. Let me mute this YouTube link. Thank you so much for joining us on this morning of a new Fed framework. Let's see. Let me start by saying, a lot's happening in our country, in our world, and we have many of our countrymen falling ill and dying of COVID. We have many millions unemployed. We have our Black brothers and sisters living in fear. And so I just want to acknowledge those things at the top. And we're trying to bring to this and all conversations around monetary policy a lightness, a festive atmosphere, and our goal there is just to make it inclusive and make it accessible and make it a bit of fun. But I also realize these are heavy times. So, all right, with that, I don't want to do too much in terms of introductions, because I think folks who are watching this probably know everyone. But we will post in the links the full bios. Julia's bio is so long; it would take like six minutes to get through it all. But let me dive in. We had Jay Powell give a speech this morning at the Digital Jackson Hole, and in addition to that, we had the Fed release a revised statement of their framework. I think well, actually, Julia, would you want to give a summary of where you think what the major pieces are, just for our listeners who might not have scrolled through Twitter?
of the changes to the framework?
Yeah.
So I mean, I think there was, to me, the big picture here is this is the flipping of the order of operations here. The goal is now maximum employment. That takes precedence. That showed up in the statement in a few ways. They actually literally flipped the words inflation and employment when they were talking about their objectives. They moved the employment paragraph up in the statement. They included more words around what maximum employment means. So I think it really is an overarching emphasis on using an average inflation targeting framework, which we widely expected. That was the most socialized thing that we were expecting. We got it largely as expected. They're going to try to have inflation centered and averaging 2%, but that's a means to an end. And the end is a broad-based and inclusive realization of full employment. And to me, that's the significance that was maybe less appreciated was, and I mean, Sam, we've been talking about this for a long time. Jay Powell is about as, dovish a labor market dove there is. Yeah. I think he took Janet Yellen's lessons to deep in his soul. He went out to the people and heard them, and I think this is his fingerprints are all over this.
Yeah. All right. So let me push you on that on the employment side. So, and Skanda and I have been going back and forth about how satisfied should we be about this. And you never want to be in the position where you pushed for something significant and then don't recognize it. So we don't want to move the goalpost. At the same time, the speech itself and most of Powell's speeches now are really sweet love songs to full employment, right? It's just tight labor markets are the greatest thing ever. They do so much. And I think to give him credit, I think that his main innovation, and I'd be curious, David and Julie, if you think this is right, his main innovation in 2019 was to say, we just don't know enough about our estimates of maximum employment to say we're beyond full employment. And as a result, like, I'm not going to be the Fed chairman that tries to bring unemployment back up
Yeah.
to some estimated level, right?
Yeah.
So like, props to him. That was big. I guess the question for us is like, if you're not actually targeting a labor market outcome, right? And is that enough? Is our framework high powered enough to generate a more robust jobs recovery? And so I'm curious. I guess I'm curious for reactions to that. Julia, David, Skanda, like, should Employ America be happy about this? I guess is like going in. We're starting at a place where we have very high unemployment right now, and we have to, we're about to hopefully start a recovery. So should Employ America be happy about this this framework?
David, you want to take that first?
Sure. I'll jump in. I'll say a big maybe.
Yeah.
I think this is, great, and that's a step in the right direction. I've been calling for a long time for some kind of makeup policy, which the goal would be level targeting, and this is a step in that direction. And why would that matter for labor markets? Well, the way I look at it is makeup policy is huge because it allows for some reflation in the economy, including labor income, or particularly labor income.
Yeah.
If you don't encourage, you don't allow for reflation, which in plain English means dollar incomes growing rapidly to get back to where they would have been in the absence of a recession and spending. If you don't have that, you're not going to have these healthy labor markets. So this opens the door for that. It gives the Fed license. It also means if you get to a level target, it provides powerful forward guidance. But I think makeup policy is a silver lining I see in this. I say a big maybe because I'm not convinced this is a terribly credible policy yet. And maybe things will come out. I think there's a lot to be done, and I'll stop there. I can discuss some of those later, but I do worry whether this will be a credible policy. But it has the potential, Sam, to make you happy.
Okay. Skanda, what do you think? Like, if we were doing this in 2008 or 2011, you just wrote a big piece about sort of inflation, the dangers of inflation target, and you look at 2008 and 2011, and let's 2008, I think is. Anyway, how would average inflation targeting plus maybe more of an emphasis on, or de-emphasis on sort of a natural rate of unemployment have fared in those periods?
I think that the latter is probably more important for our purposes as far as de-emphasizing the whole idea of, I think one of the critical changes in the document that was released today was they changed from talking about avoiding deviations in unemployment to talking about addressing shortfalls. So it's effectively saying there's no such thing as too much employment, right? Now, maybe there's some other problems that are associated with that need to be addressed. But the notion that like we're symmetrically optimizing the amount of employment in the economy is not actually true, right? So we are going to, and that runs counter to a lot of the Fed forecasts that were effectively projecting that optimal policy would raise the unemployment rate, right? So that I think was not something that was widely talked about or expected coming into today. And I think that's probably what Julia was saying, a very positive development. I think the average inflation targeting point is one where I'm conflicted in the sense that I do understand that they're trying to be more accommodative to welcome or increase the probability of tight labor markets. As to what David was saying, there is a chance for reflation. You don't do preemptive tightening the way they did in 2015, 16 to 18. So you don't actually try to tighten if the economy's running, don't try to choke it off in terms of sort of reducing, trying to preemptively avoid future inflation, like at least try to see some of it. I do think it sort of misses the point that like to all the things that David was talking about, to my mind, it's why not calibrate policy with that specifically in mind, specifically trying to raise dollar incomes. That seems like we're kind of doing this very indirectly through inflation to talk about labor markets. This is I get that there is a dovish overtone to some of this, but inflation can do very weird things in the moment and can distract both FOMC members and financial markets. And I think 2008 and 2011 are the two examples I think of where there was divergence. This is also the 2011 in particular was when David and Scott Sumner's ideas around market monetarism and nominal GDP targeting were very, like, I think kind of got into the popular discourse more so because inflation was doing something very different from the economy itself. And I do worry, while Jay Powell and people like Janet Yellen have a certain set of instincts that say we need to deliver accommodation when unemployment is high, I don't think that's necessarily what average inflation targeting implies all the time, right? I don't think it's, not everyone's going to have the same worldview or the same set of values. So it does lead to more fragility in those types of environments. Again, it may not play out, right? So if we're talking about the sort of late 2010s when we had both low inflation and low wage growth and low nominal GDP growth, when all those things are moving in the same direction, this is a helpful policy, right? But I think it is something where it does feel like a very oblique way of actually trying to attack the issue of labor market tightness.
That's a little bit, just if I can add one more thing. Yeah, that's a little bit my concern is like, you know, the framework is supposed to be a structure that persists across different FOMCs, right? And I kind of worry a little bit that the, you know, we're calling it dovish because we're marrying it with, you know, the whole Powell emphasis on full employment. And, you know, when Don Jr. appoints Judy Shelton to be Fed chair, you know, we're gonna like, will the framework be as robust? Well, we might have other problems in that scenario, but but even in a lesser scenario, you know, are we overweighting the dovishness of it because of the messenger, and because we've just come off this period in 2019 where he did exactly, you know, this thing where he you know, the committee wasn't willing to push unemployment up. I don't know, Julia, you want to weigh in?
Yeah, I mean, I agree with the points made. It's sort of a do no harm statement. It's not a guarantee. It's not a stated objective. But, you know, I will say one of the reasons that might be the case is that it's not clear they have the tools.
Yeah.
You know, their toolkit is increasingly, you know, not well suited to the job. They work through asset prices, the credit channel in an aging society, and in an aging society characterized by extreme inequality, the credit channel is muted at best. It's there, housing's doing well, it's there, but there's tons of people left out of that. And the asset price channel, even more people are left out of that. So full employment is a truly macroeconomic outcome that, as Powell stresses, really means we're getting to the people that are the most vulnerable. They're the ones that suffer the most in a recession. They're the last to realize the benefits of an expansion. The Fed doesn't really have the best tools to get at that. And so, you know, they could, David made the point earlier about they're going to kind of have to prove their credibility over time, right? And you know, that's the danger of making a bolder statement about full employment objectives, which I'm extremely sympathetic to, is that they may lack credibility even more than what they've done today.
Let me ask you, so on tools, and David, we're gonna come back to your, in the chat, people are asking about, you know, credibility, and we're gonna come back to it. On tools, well, two questions. One is, I know you've thought a lot about tools. Three questions would be, one, are there tools that they already have legal authority to do that they should be talking up more? Two, are there tools they should get legal authority to do that they don't currently have legal authority to do? And then three, you know, my thing is like, should they be talking up more fiscal policy so everyone is socialized to the notion that, you know, we need fiscal policy to do more of the work. They could even call for, you know, more rule-like fiscal policy, like automatic stabilizers or something like that. Anyway, do you want to take one or all of those?
Well,
Julia?
Sam, can I jump in? I want to go back to Julia's comment about do no harm. I think that's key. Even if even if we acknowledge maybe the Fed doesn't have the tools it needs, it still has the ability to do great harm. And the challenge is being able to let inflation rip if it needs to temporarily on the upside of a recovery. We want the economy to run hot. We want to get back to full employment. We want to have nominal incomes back to where they would be. And the danger, in my view, with this policy is it's going to be hard for policymakers when we get 2% inflation, 2.5% inflation, and pundits start crying out, the market starts worrying, Congress starts worrying. And it may be hard for the Fed to do no harm. They might be tempted to raise rates. So I think even before we get to the question of additional tools, can they constrain themselves from raising rates like they did in the past? And our hope is this policy does that. But I'm still not sure. This goes back to credibility. I'm not sure, though. We'll have to wait and see when they go through a true test of inflation going up.
Yeah. That's fair.
We have another question from folks about credibility. David said a few times, one of the main problems of Fed right now is credibility. What is the main change in that direction with average inflation targeting instead of inflation targeting? Do you think there's a significant change here in terms of credibility?
Well, I mean, let me speak to this since I brought it up, but I'm sure the other two would like to respond as well. The two big credibility questions I see is one, this policy, as we've alluded to earlier, under it, you have to sell higher inflation as a good thing.
Yeah.
You got to tell people, hey, I know you just went through a recession. I know you've come through a pandemic. Let me generate a little extra higher inflation. It'll only be 6 months, a year, but this is what you need for a fix. And they're constrained to do that because this is under the framework of an inflation target. I think Skanda was alluding to, it'd be a whole lot easier if we just said, look, what we're really aiming to do is to restore nominal incomes or your dollar incomes. And as a byproduct, maybe there'll be some higher inflation temporarily. And I think that's where credibility comes in. I don't, again, think, and I worry that the Fed, when it comes to this point, may back down and not do no harm. The other concern I have about credibility with this is average inflation targeting, the parameters around it aren't defined very well. And they even said in this statement, and I think Powell mentioned it, that we still reserve all the discretion.
Yeah.
And I think in this case is actually detrimental. If you don't define well what average inflation targeting it is, it leaves a big open hole to make it up as you go along, and therefore you get back to what we already have today. One of the benefits of a pure price level target is it really does tie the hands of the Fed and says you have to get it back up. But the fact that it's so vague and uncertain, I think that undermines its credibility as well.
Yeah, I thought they were going to do, I thought they were going to anchor around the Bernanke proposal, which is however many quarters we are at the lower bound, we're going to make it up with quarters above 2% inflation. I'm probably butchering it a little bit, but he had some metric around that. But yeah, they kept discretion. I wonder if that was like a escape clause for financial stability.
Yeah.
They did strengthen the financial stability escape clause. I mean, they had one in there before.
Yeah.
They added some language, that kind of strengthened it a little bit. So, I mean, I think, credibility comes on a number of fronts. So David, I agree with David, like if you're going to be truly credible, like it would be a lot more effective to tie your hands. On the other hand, you might not still be fully credible because there are these other dimensions that they do care about. And there have been times when those, all else equal, they still prefer to use non-monetary tools to address financial stability, but they get nervous when markets get super frothy and debt starts piling up. And I don't think that that's necessarily something they should take off the table. Those are how imbalances that can be very detrimental to full employment over the cycle can develop. So I think it's just inherent to the institution and how they make decisions, that there's going to be some squishiness. And I agree that the proof will be in the pudding. And I think Powell has acknowledged this too, that, you know, this anchoring of inflation expectations is something, or, you know, if they want to re-anchor them a bit higher, it's going to take some time. They are going to have to prove themselves.
Yeah.
I do think that in effect, what they've done with how they look at inflation is, look, unless inflation is coming from wages, it's not going to be persistent. You know, supply chain driven pops, energy price pops, you know, they look through those. They've done it before, they'll do it again. But, you know, I think, Sam, you mentioned that kind of requires that the personnel is that kind of technocratic, credible people that want the right thing for the medium-term interests of the economy. If we, you know, follow that tradition of appointing those types of people, then you'll get that outcome, but there's no guarantee. So, you know, that's, you know, at the end of the day, the Fed is a political institution tied to the whims of Congress, and, you know, it's subject to some of that malleability over time.
To that point, and to what David was saying about like the political language that's, or like, I think obviously with sort of the political alignment right now of, you have Congress that's not really criticizing the Fed for being overly dovish, right? I don't think you're really seeing that aside from maybe a couple of senators, but like generally speaking, under Trump's presidency, we've seen actually a more dovish Republican Party, and the Democrats have not gotten particularly critical of the Fed for being overly dovish either. But I think you could see the scenario where this sort of language sounds very tone deaf, right? Where you say, we are shooting for higher inflation itself. I think this is where like part of the political credibility, central banks do not operate, they may be independent, but they don't operate in a political vacuum, right? So there still is political pressures. If we think back to 2010, 11, 12, where there was a lot of scrutiny of the Fed in terms of what are you actually trying to achieve here? Are you trying to debase the dollar? Are you trying to just create inflation and raise my cost of living? Or are you trying to achieve something? The actual thing that I think to your point about sort of the inflation pressures that I think a lot of FOMC members who are dovish are thinking about are the ones that are wage driven, right? The ones that are income driven, not supply chain issues that should fall out of the system in 12 months time. Like that, but I think it's worth being explicit about that, because otherwise I feel like we're also going to get back to square one where we're going to be talking. It's not that hard to see a scenario where you see the faster inflation temporarily. And the question is, what should the Fed do about it? I think the problem with some of the level targeting stuff, and I think this is why some doves even, I think if you read Brainerd's speech from earlier this year, Governor Brainerd talked about how I prefer a more flexible approach, precisely I think because it's not because she wants to withdraw accommodation necessarily in those sorts of environments. But let's say we did get some kind of excess of the price level target itself. Does that necessarily warrant tightening? I think it really depends on what we're talking about, right? What kind of price level overshoot are we really seeing? Is this the kind of thing that is idiosyncratic, transitory, or is it actually driven by some persistent pressure? And I think that's, to me, all of these like linguistic and credibility problems really would be better hammered out by moving away from the sort of inflation-centric paradigm that the Fed has fenced itself into. And then it really depends on who's the personnel. And I think that kind of gets away from the whole notion of a framework, which shouldn't really be highly dependent. Personnel always matters, but like to the extent it really turns on who's the Fed chair, like, or who are the FOMC members? Maybe that's a better way to put it. What's the composition of the FOMC? I think to make that count, and we're moving away from this sort of framework would actually be helpful towards that end.
Well, I think there's scope for moving in that direction over time, Skanda. I think, you know, again, if our understanding of inflation dynamics and sort of persistent inflation dynamics is ultimately rooted in wage dynamics, sort of, you know, there is some scope for maybe in the next 5-year review, you'll get your wish.
Yeah. One thing that I wanted to bring up, given some of the things both of you talked about, was the framework review was supposed to also discuss tools, whether the Fed had the right tools. And that really did not get a lot of attention, right? Powell didn't really talk about it in his speech. And yet, I kind of can go both ways on this in the sense that we just see now, kind of unpredictably a little bit, that like Fed now has all these new authorities under the CARES Act to really lend to more of the economy. They kind of have fenced themselves in by sort of certain rules that say we have to lend at a penalty rate. We can't be too generous with our lending. Some of this is just really a function of their choice. So they could actually do more if they were creative enough. But some of it also does reflect like, look, credit channel is not the same as it used to be. And so it's a question of, are there other ways to explore new tools? It strikes me this would be a much better emphasis of their time than trying to toggle with, I don't know, a few sort of a handful of basis points on inflation expectations. If we're talking about like moving it back up to 2% or targeting 2.2 or 2.3% on core and headline PCE, I'm not sure like these inflation expectations sort of calibration exercises are as like, is it really worth their time for the past 18 months relative to the toolkit discussion? I think it's important to at least discuss the strategy, but it has to be sort of rooted in like, do we have the right tools to do the job too?
Amen. Woo!
Same way.
I mean, they spent so much time fine tuning this little average inflation targeting thing. And when push came to shove in the recovery, it was all about the balance sheet. 150% about the balance sheet. And the statement still says their primary tool is interest rates. No, it's not. It's the balance sheet, guys. Hello, it is the balance sheet is primary and interest rates are a companion to it. That's how I see it in terms of sitting in financial markets. What has had the most impact in catching the falling knife in when the COVID recession hit and markets seized up? It certainly wasn't interest rates. I mean, that was part of it, but the balance sheet and then the credit facilities, and they're still, Powell, they're struggling. That's a lot that they were asked to take on in a very short period of time. I'm very sympathetic to the personnel and logistical issues, but
for Julia, maybe for Skanda too, and any Sam, you as well. Why don't we have more healthy discussions about the tools? I mean, is that itself a product of the political environment? Is the Fed hesitant to go there? I mean, Julia, you have some great ideas. Several.
Yeah, so do you.
Yeah, but you've been thinking, I think, about this longer than I have. But why haven't we seen this more, openly discussed? Is it a function of the environment or what?
I think that there's also a function of personnel and it being new, and it's a new front. And I think that there's not a lot of, the Fed tends to have been a more academically based institution where they want a theory and some evidence to, make decisions based on, which is admirable. I'm not, discounting that, but naturally speaking, when things change very quickly, it's hard for them to adapt quickly. And I still feel like there was, Bernanke, boy, to get to QE 2, QE, that was such a heavy lift on the committee. And the staff is still kind of, love the staff, a little behind the curve on balance sheet, sort of, really kind of thinking about how it interacts with financial markets, the different dimensions. They're now moving, like some of the more recent staff papers are, using a VAR framework. They're more flexible. They're more open-ended about the channels through which this all works and how it coordinates with interest rate policy and forward guidance. But it was really, really amazing to me during the review that wasn't right there in the middle, right? Like after we'd gone through and there was kind of a little presumption, and this was on the part of investors too, that, the next recession will be more like a garden variety recession.
Yes.
It was complacency, and it's amazing how quickly complacency returns.
Yes. I remember a significant former Fed official saying, we shouldn't just assume that the next recession will be as big, as the Great Recession. I was like, we should assume that, it might not be, but we should. Yeah. But Julia, can you say like a few sentences on your two ideas for new tools, recession insurance, and your I forget what you called the direct deposits to households.
Yeah. I have a proposal with Simon Potter, the former markets group head at the New York Fed, and I mean, you all know who Simon Potter is. So to create a system of digital currency, digital payment providers. That's one thing that we. I think that the Fed, and they are moving in this direction, and Brainerd's recent speech definitely I felt was a pretty big move forward on the thinking of the Fed should absolutely be on the frontier of digital technology and delivering the benefits of digital technology to the public.
Mm-hmm.
It can provide a more inclusive, lower cost, more efficient, faster payment system. It can create better financial stability as a result, and a more inclusive financial system. So that's one prong of it, is they should embrace it. They should work diligently to put that into place. And then that would facilitate, with the blessing of Congress, it would have to be authorized by Congress. And we have a construct of recession insurance bonds where Congress authorizes a certain percentage of GDP that the Fed can deliver into these digital accounts in a recession.
Mm-hmm.
So it's money reigns. It's just helicopter money direct to consumers. This is not a new idea. It's just operationalizing it. Simon is, excellent on operational and plumbing issues, which matter so much to getting policy right. And again, I don't think enough policymakers weight that as heavily as they should. So that's what our proposal is about. And to me, one, it does belong. This isn't fiscal policy. I mean, look, if we got automatic stabilizers a la, Claudia Som's proposal, I'm all for that, 100% supportive of that. But at the same time, this is a different way to operationalize that. And it is arguably the domain of monetary policy. Because, why did we develop an independent central bank over time to take decisions with a medium-term view, but based on near-term circumstances? Because fiscal policy gets stuck in the mud, only in the most extreme circumstances. It's too little, too late.
Mm-hmm.
And the Fed can, if the Fed could have jumped in and deposited, $500 into everyone's account in mid-March, then they may not have had to go as far in buying corporate bonds. And because the people would be insured. And that's ultimately what businesses care about anyway, is the risk to consumer spending and the real economy. So if you can insure the consumer better, and again, have lots of guardrails and to limit the Fed's reach into this area, that's imminently doable. And then you can deliver, and it's monetary. I mean, ultimately, when something like this is a contraction in the money supply and the credit channel working in reverse, it's very disinflationary, deflationary. The Fed's goal is to reflate to consumers. So that's the idea.
And Julia, it strikes me that one thing coming out of this crisis, I can imagine Fed staff or Fed officials being like, we'd rather give that Coronado idea some legs versus having to set up a permanent, municipal facility or right. It would be interesting. It would be interesting if this, experience makes them more wanting to do this based on where they have ended up. I mean, I don't think they are happy about where they've ended up in terms of, all the things
they are not
engaged in. David, do you have a reaction to this or?
Well, I have a similar proposal as Julia's. I mean, very similar in spirit. I will invoke my few chances you've given me to bring up nominal GDP targeting. Only a few times, but I'll bring it up now. So I like Julia's idea, and I agree, only in emergencies with guardrails, with the sign off from Treasury Secretary, all the proper checklist. I think helicopter drops tied to something like a nominal GDP level target. So again, we're doing this, but in a systematic fashion to the point, we keep doing it until we reflate and restore incomes to where they should be, not just a one-time shot. That's the problem with what we saw with these checks that we're sending out. It's a one-time shot, depends on the mood of Congress, the president. We want a systematic, rule-like process in place. So yeah, I'm very sympathetic to what Julie has outlined.
What about your colleague Scott? I think it would say, forget all that. Just buy up. Just keep buying stuff. Buy everything the Treasury puts out there. You can buy it all up, and when you get done with that, you buy every single corporate issuance. And when you're done with that, buy whatever else paper is around. Why have? Yeah, is there a distinction there?
I mean, I can't speak for him, but what I would probably say is, and I would agree at this point, just having a level target in place could go a long way. So it may not be enough, but having a level target so you're putting the proper guardrails in place. But I mean, you could do a thought experiment, which this is not very practical. Again, I would defer to the more operationally sound stuff like Julia suggested. But you can do a thought experiment where, if the Fed could do this, why not buy up the whole planet?
Yeah.
What at some point we would see inflation and demand kick in, but there are political constraints that kick in. There are asset supply constraints that kick in, and so I think there's probably a practical limit. But you can see the logic of the argument. But like Julie, I proposed what I think is a middle ground, a practical middle ground where and I like the way Julia frames it. It's the monetarist in me likes to think in terms of quantities, and what she's proposing is increasing the monetary base to the point that the economy's, reflated.
And Sam, I will say, to add to that, again, given what we know, what we're seeing in terms of the distribution of wealth, reflating asset prices just doesn't get the job done anymore. And we'd already seen that before this crisis hit. I mean, the wealth effect on consumer spending, which in the 90s was a big thing. And I was at the Fed in the late 90s, early 2000s, and we ran our consumer forecasting models based on the wealth effect. It was 3 to 5 cents of every dollar would go into the economy over the following 6 quarters, or come out of the economy in terms of wealth losses. And it died. It actually absolutely died. If you run these models now, the wealth effect is zero, because wealth is so concentrated, and wealthy people save less and are less responsive. They buy what they want to buy regardless of sort of the fluctuations in their wealth. So that wealth effect on consumer spending is de minimis. And it doesn't matter if you break it out into housing wealth or financial asset wealth, it's basically zero. And so it's already broken down. I think of right now what the Fed's doing, it works very asymmetrically. It prevents a negative feedback loop. We all know that if asset markets were collapsing and the Treasury market was seizing up, that would be unambiguously bad for the outlook. Yeah. But now that we've got the S&P 500 at new highs and Tesla up, 6,000% in a month, does that actually predict growth? No, it doesn't actually. So it's the impact of their policies through these asset price channels is very asymmetric, and that's just not desirable over the longer run. I think we need to have a bigger, bluer sky discussion about tools.
What do you think, Skanda?
Yeah, I mean, I think that Julia's ideas for sort of being able to do sort of functional helicopter drops, I think this is where like institutional frictions really do matter, just by increasing the amount of bank reserves in the system alone. Like that doesn't necessarily translate into more spending in the economy, right? Like there's more to the causal chain that goes missing. So I think when you heard the Fed 2 years ago, the sort of party line was, well, okay, we'll be at the zero lower bound. That seems kind of scary, but we also have forward guidance. So we also have the ability to buy treasuries and agency mortgage-backed securities. And we're going to kind of hope it's fine. And maybe we need to do this sort of framework review with sort of like a way to kind of buffer inflation expectations, and then we'll have like lower real rates when we're at the zero lower bound, and that's going to be kind of like the solution. Obviously, it's like this is wholly like inadequate for this kind of crisis, right? And that's why we also have CARES Act authority that's like in place to allow the Fed to lend broadly, get more directly to businesses, to state and local governments to some extent, right? So now they actually do have some authority. It's probably not, it's not optimal form of authority. I think direct payments to households would probably be both more neutral and more broad-based. So it seems like that's probably a more optimal tool. You have seen that the Fed, like, there's just this comfort level with thinking about things purely in interest rate terms. To think about it as the models are all designed around like what is the optimal interest rate that kind of gets you to full employment and gets you to, or rather gets you to whatever U star is, whatever sort of is, it gets you to the inflation target or whatever goal you have in mind. That the interest rate is kind of the key metric to toggle with, and the Fed just seemed very comfortable with that sort of. They're not. The moment that the discussion moves to tools, it feels political, it feels greasy, and they don't really want to get their hands dirty. But it's like this is actually the thing that mattered the most. So I think there's like a big. So I think there is a room for robust discussion of the income target versus like having an average inflation target versus an income target versus a different sort of framework. I think that's a really big part of this, but also like the tools that make this all possible. It's just so striking to me that the Fed spent so much effort on this when like we really should be talking about what kind of tools really help to achieve those goals too. And I think the Fed just got very comfortable with that. And it seems just a little bit dissonant when like Jay Powell is talking, we're in the middle of a recession, we're in the middle of a pretty big crisis, and Jay Powell has to kind of explain sort of like new Keynesian macroeconomic modeling about how we're going to get the real rate low enough to get the inflation expectations are going to sort of change if we commit to higher inflation, but we're not going to really commit. Like this is all like very arcane stuff. It's not really clear that like for how arcane the discussion is, it's actually as powerful as sort of it's being hyped up to be.
I want to make sure we're somewhat responsive to the comments in our YouTube chat. So Ernie Tedeschi, some guy on the internet. For those who don't know, Ernie is a friend of everyone on the program and the shadow Fed whisperer.
And we cannot live without his labor market analysis.
We can't live without him or his labor market analysis. And he asks, do you all think U3 base NAIRU is now dead as a policy metric, or will it live on? Or will it be replaced by a broader measure or a basket of measures? And like this is, I'll take the
Yellen's dashboard.
Yeah, so Yellen had a dashboard. It's clear that from day one, Powell sort of hated NAIRU. I think it was clear from day one. I mean, his first speech was about taking aim at the stars. And I think he's been really dismissive, both in congressional testimony and his press conferences about past estimates. But it's a very interesting question. Like what replaces it, if anything? So I'm curious. Yeah, I'm curious for everyone else to weigh in.
Skanda has an idea, right, Skanda?
I hope that U star is dead in terms of at least how it's functionally used in like. I think you can make an argument that there's always a U star that always like exists. If we have inflation too low, that means U star. We're not there yet. If we have inflation high, that means we passed U star. You kind of like have a post hoc analysis of what like the natural rate of unemployment is. But just functionally speaking, the Fed, like Jay Powell talked about this in the speech, and I really enjoyed this part, which was these estimates kind of move pro-cyclically. So we just kind of move them up, move them down really slowly, so that like the natural rate of unemployment is supposed to be the amount of structural unemployment in the economy, or everything that's not cyclical, I should say. And yet like this thing just moves around and we kind of just know it after the fact. So then like how much usefulness is there in saying, well, we know that the natural rate of unemployment is within is 5%. And then, oops, we actually find out later it's not. I find this to be a very backward way of thinking about maximum employment, right? And I think the changes suggest that the Fed's going to really think about employment from a standpoint of, there's obviously a problem when we have like depressed employment, when we do see these sort of asymmetric shocks, and we need to address that. That requires pressing, and I think that's all very good. I think what's really weird about the last 5 years of the sort of 2010s expansion was that the Fed was talking about how unemployment's at risk of going too low, that we're actually going to have, like, we need to get the unemployment rate back up. There's like, and these are people who were like historically considered more dovish, people like Eric Rosengren, Charles Evans, even
John Williams,
Lael Brainerd, even in this direction, that like we got to be worried about like sort of low unemployment, because there was this sort of story that's been told.
Bad things happen when unemployment gets too low.
Don't you see that we got unemployment really low in 1968 and 69, and then you started to see core inflation creep up, and that's actually why we got the 1970s great inflation. Obviously, like there are plenty of people who disagree with that narrative, but it's a pretty powerful one within the Fed and within the institution about sort of the risks of keeping employment too high. And I think that like getting rid of that, both in terms of like politically, if the Fed wants to sort of maintain some political independence, I think it's important to kind of stamp that out. But also like, yeah, it's just like, it's a very grim and incorrect view, I think, of how this is supposed to work. So I do think it's a positive. Whether it actually means the end of U-Star, I think Jay Powell is more dovish on this question than say the staff is. I think the Fed staff is more wedded to the idea that we still have to find some sort of U-Star to make these models work. And so like
it all comes back to the models.
Yeah, so I do think that like there's that it'll still exist in Fed models. It's not going away, but right. I think there's going to be more willingness to think dynamically about like, okay, U-Star's
inherently the makeup strategy that comes in is a dynamic thing, right? And so we've stepped decisively away from a Taylor rule, which even, you know, a forward-looking Taylor rule is kind of a spot estimate, right? It's not as dynamic as, you know, thinking about things over the cycle. So we've stepped in that direction. I think if you think about practically how the policy conversations are going to change with a de-emphasis of U-Star, I think we do start moving in the direction of talking about income and wages, right? Because what do we care about? How do we know where we are? And Powell was the one, I mean, again, all kudos to Janet for starting this movement in this direction. And then Powell took it, and that was what the metric he said, like, look, we don't know what it is, but we'll know based on wage growth.
You gotta see the heat to call it hot.
Huh?
You have to see the heat to call it hot.
You have to see the heat to call it hot. And so we're moving in the direction of an income target de facto, if you think about how this manifests itself in terms of policy decision making. When you're at the table and you're talking about what do we need to do to the setting of policy? Well, you know, where are we on the U3, the U6, participation, all the metrics on the dashboard, and at the end of the day, wage growth. Is it keeping up? Is it going beyond productivity? I mean, we never really got there in the last cycle. We were just starting to get there, not even really getting there. And so, I think the practical implication of stepping away is going to be powerful over time.
I hope you're right. And I think, again, going back to what's been said, it's difficult to know what these stars are in real time. I mean, you're playing God here, you know, no one really knows these measures. And that's another argument for, you know, nominal income or nominal GDP targeting. You kind of take a hands-off approach in the near term, but over the long run, you're still aiming for some kind of, you know, price stability, some kind of nominal anchor over the long run. But in the short term, you say, look, we simply don't know. And we're just going to, you know, focus on stabilizing nominal income growth.
Yeah, I mean, I think this is sort of the market side of Powell kind of showing up as well, in that like he is more mistrustful of latent variables. That's what the whole 2018 Jackson Hole speech is about, like, how am I supposed to know where any of these stars are? And it's the kind of person who wants some price confirmation or some kind of evidentiary confirmation to say, okay, this is where the stuff is. So, okay, if you want to keep your U-Star, and R-star oriented models, it's fine. But there has to be some kind of check in real time for how I decide this stuff. And I think what I hope I hope the narrative that you're constructing, Julia, comes to fruition. I think it will be interesting to see how the Fed, as the personnel just evolves within the Fed, both staff, FOMC members, whether they really take that to heart, right? Whether they take it to heart that there is more to maximum employment than a low U3. There is more to maximum employment than even a low U6, right? There is wage growth. There's all sorts of other measures we need to sort of fold in. I think that if we really think about like business cycle analysis and like actually what to track in real time, it's hopefully we'll move towards something that's more like income targeting, right? That's a lot more reliable guide for where things are going in a way that, yeah, I'm just afraid a little bit of like sort of the when we have this discussion, are we discussing wage growth? Are we discussing income growth? Or are we gonna end up discussing, well, cell phone prices, the methodology changed and all of a sudden go down that road. And it's like, it could be a real false flag for like what we should be focused on here. But it's very possible that all of these sort of moves end up taking us to a much more constructive place. Hopefully, as I said, if we can get to de facto income targeting, that would be a big plus because the proof's in the pudding there.
All right, we're coming. I want to ask one question that's a little bit more specific. So if you look in the strategy doc that the Fed put out, they have basically, well, let me back up. There's this thing called the divine coincidence, which basically says we'll get price stability when we close the output gap, right? There's no conflict between our goals around, labor market growth and price stability, right? And, the Fed says, well, that's not always true. So I'll just read here. The committee's employment and inflation objectives are generally complementary. However, under circumstances in which the committee judges that the objectives are not complementary, it takes into account the employment shortfalls and inflation deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with its mandate. So here's my question, and I'm particularly interested in David and Julia's answer. So we're going to take into account deviations, and we're going to balance these kind of equally, right? We only have a target for one, not the other. So how does that work? I guess I'm curious, how should a layperson understand sort of when those two things conflict, how the Federal Reserve, which is this hugely powerful institution, sort of balances them against each other. And any thoughts on that question?
So it's trickier. Obviously that was one of the appeals of the sort of loss function framework.
Yeah.
That they basically had in words in the statement before was when they conflict, we will weight them equally and we'll calculate the loss and we'll weight it equally, and a number will be spit out as to which one. And that's the appeal of having a framework like that, and that's the appeal of the modeling and all of that. It's much harder to not have those goalposts, but there's a reason we're stepping away from them. They led to mistakes. They led to significant policy mistakes, and U-turns that hurt the Fed's credibility, and so there's no perfect solution to this. I think it's just
it's we're back to Chairman Deng sort of crossing the river by feeling the stones.
Yeah. I guess following up on what Julia said, it depends on personalities, how they interpret this. And as you mentioned, to me in an earlier exchange, 2021 is going to be a big part of the story, right? The personalities that end up at the Fed, who's going to be chair. All of this discussion today could be for naught if we get some different personalities. But we hope there's continuation and progress on this front. But people do play a role. This is the real world. Politics are real, so we have to keep that in mind when we think about it.
Yeah, absolutely.
David, do you have parting thoughts for us on the framework review, Powell's speech, anything else? Our
Yeah,
audience should-
I will quote a classic line from Dumb and Dumber. So you're staying there to stand. To stand for nominal GDP target. Again, this is a step, in my view, in the right direction. I think it would be hard for the Federal Reserve to do something really radical like what I want, but I think we can make incremental moves in that direction. It's all about credibility and getting there.
You have 5 years to get New Zealand to not only adopt an NGDP target, but actually see it work out successfully.
I'll do my best, Sam.
Julia, do you have any parting thoughts?
You know, I think that the next time that a Congresswoman or man asks Chair Powell, do you have all the tools that you need to get the job done? I think he should say, actually, I think a review of our toolkit would be a fabulous idea, not just an internal review, but a congressional review, and maybe, you know, some kind of commission or whatever, and really think outside the box, and because I don't think that in the world we live in of slower growth and lower inflation and all of this, that that achieving their mandates is going to be easy with the toolkit that they have.
You heard it here first. The February Humphrey Hawkins is going to be, it's going to have fireworks.
It's going to be lit.
Yeah. Skanda, closing thoughts?
I mean, there was something David said earlier about sort of the Fed playing God with some of these sort of like different like major variables, and we're talking about sort of Congress's role in all of this. I mean, it does seem to me, while it isn't like Congress is itching to get into any of these discussions itself, it does seem like part of like what does like a proper review look like of the Fed's goals and framework should have some congressional and White House input. I think that's probably, it seems to me they've not really shown much interest in getting engaged in this discussion. I think there's a tendency to just defer to the Fed. Sometimes that's a good thing, and sometimes that's not a good thing. But it seems like part of like the process here, there is something a little bit like, if you look at other countries and how they go about reviews, like this process isn't something that is like done in a vacuum. The central bank just operates completely in a vacuum when deciding these goals. And especially on things like the divine coincidence, like, is there just a point where if we're at the inflation target, we're also at the at full employment? Is that actually how this stuff works? That's something that models can sort of already predefine for you, but it seems like that's also inherently a political question too, right? So I do wonder, like, whether we see Congress try to say more. The politics are going to change one way or another after this election. So that probably will color sort of what is the political feeling around what the Fed's done and whether the Fed needs to do more things in sort of any direction.
Okay, those are great thoughts. I've really enjoyed this. And I thank Julia and David in particular for coming on. We're always interested in new ways we can communicate and new forums we can host. So if you have ideas, I think the best thing is to tweet at us at Employ America is our handle. And I hope everyone has a good rest of the week.
All right, thank you.
Bye.
Thank you.